So I'm joined by Phil Rush. He's the chief economist at Heteronomics. A top economist at Goldman Sachs say they aren't that worried about a recession happening, and the bank has cut its expectation for a US recession over the next 12 months to 20% from 25%. What do you even make of this?
In terms of the specific probabilities, if anything, I'm probably even more relaxed about the recession risk than Goldman's. 20%, isn't that unreasonable. There were concerns when the US unemployment rate increased unexpectedly and quite sharply. We also see strong GDP growth, really strong surveys. The run of data in recent weeks has been consistently better than expected and pretty resilient. So there isn't anything else that's saying there's about to be a recession. So I would believe that the possibility of that remains quite low.
When do you next expect the US to cut their interest rates? And what do you expect them to cut them to if they do?
The latter part of that has become more pressing since those market moves. My view all year has been September. Now, at the start of this year, the market was pricing rate cuts in from actually in Q1. And then as that demand resilience we were just talking about came through, they kept rolling back those expectations for the first rate cut. Now, as we've seen this ongoing flow of better data, that possibility of an emergency rate cut has disappeared. No one's calling for that now, and that's right. There shouldn't be an emergency rate cut. And the probability between 25 and a 50 basis point move in September has increasingly skewed back towards a 25 basis point move. I still believe that it will be 25 basis points. The risk skews towards 50, but I believe the risk is skewing less than perhaps the market has been pricing, but that will continue to come down. Particularly like the next payroll release will be a big determinant of whether they go 25 or 50.
Now, say if a recession does happen, how would this one be different to 2008?
So it would be very different to 2008. 2008 was both an economic crisis and a financial crisis. So the banking sector didn't have enough capital and enough liquid assets to withstand the losses that they were incurring on their loan books. So at the same time that you found everybody in the economy couldn't access credit and they were losing their jobs and they were reining in their spending. Now, banks are far better capitalized with an abundance of liquid assets. They will be fine. And the stress tests have kind of shown that. So this wouldn't be a 2008 story. In my view, this is actually much more like a 1998 scenario. And that's not because you've got a kind of new Labour around. It's that you have global central banks easing in anticipation of a recession that hasn't yet happened. And there is a long and embarrassing history of central banks cutting rates outside of recessionary regimes, with only one successful episode. Every other time that they have done it in the US, Euro, UK, every other time they've ended up being proved premature and within several months have had to reverse those interest rate cuts with rate hikes that go to new cycle peaks. And it's that shock of re-hiking interest rates that is ultimately the thing that kind of re-steepens the yield curve, makes everybody's borrowing more expensive, shocks everybody's system and drives the recession. So in the 98 scenario, you had Russia crisis, Asia crisis, failure of long-term capital management as a big US hedge fund. The Fed cut, Bank of England did, the newly independent ECB not too long later. And it was actually that trigger of that first Federal Reserve rate cut that kick-started the dot-com bubble. There'd been a bit of froth early in the year, and then like tech stocks had crashed, but it was actually that the realization of that rate cut that made everyone go, great, fill your boots with risk, go do these momentum trades, buy tech because it's going up. For people that are considering things over a multi-year horizon, they should bear in mind that the sort of easing that we're going to get is not like 2008. It won't be cutting to the floor with QE. It's like a gradual little cut, and it has the very worrying historical regularity that it could be reversed to higher interest rates in the future, which people should be prepared for, even if central banks are not talking about that.